Hi, this is Kerry Artek with Wicked Stocks, bringing you video analysis in the primary ETF treasuries. The symbols SHY for the 1 to 3 year, the IEF for the 7 to 10 year, and the symbol GOVT, which stretches out to 30 years. It's a mix of maturities, but it is, for all intents and purposes, the longer term ETF or Treasury bond ETF. This is big picture analysis. I did record this the week of Monday, November 29th. Truth be told, I recorded it on Tuesday, November 30th. Before I jump into the charts on all three, I've got a couple of dozen charts, maybe not that many, but pretty close to show you. Would love it if you actually clicked like, if you like this video, and subscribe. Subscribing to the Wicked Stocks YouTube channel will provide you immediate notification whenever new content has been uploaded to our Wicked Stocks YouTube channel. I have a daily SPY report that goes out. That's the S&P 500 Spider ETF. A daily video on that, soon to be a triple Q in a few weeks. And then I upload occasional sort of extras, this being one of them. I think it's important that we look at kind of the interest rate outlook right now and what's happening on both the near and long-term U.S. Treasuries. Without further ado, let's jump to the charts. I'm going to start with the near term and work my way out. So this is the iShares 1 to 3 year Treasury bond. The symbol here is SHY. These are all weekly bar charts, by the way. And, one of the things I can show you here is the fact that we haven't tested it. We may well in the weeks ahead, but we have the beginning of a long-term zone of support that begins at 85.32, this former channel top. This market pushed through over a year ago and may well retest on the way down as it seeks support. 85.32 is the beginning of a zone of long-term support down to 84.86. Now, I understand that there's a wide zone, but generally this is an area where the SHY or the 1 to 3 year Treasury bond could conceivably bottom out through 2022. And from there, consolidate, turn higher perhaps. I don't see a real long-term sell signal in the 1 to 3 year until it settles below 84.86. And that area is narrowing ever so gradually. I'll be watching this. If we slip into this zone of support, I'll give you downside targets in the event we actually violate it. But we're away from that. I think we're probably several weeks away anyway from testing it. Let's take a look at the upside. I'm going to zoom in just a bit here and show you that 86.15 is a descending channel top that includes trade for the last 8 or 9 months. We put the high out in early part of the year. I think that was a February high. And we've been, sort of meandering in this downward slope ever since, most dramatically the last few months. So channel resistance at 86.15 is actually expected if this ETF, symbol SHY, actually closes above the high of the low that was put out a couple of weeks ago at 85.88. So if the SHY closes above 85.88 at the end of this week, the 86.15 formation is then expected within 1 to 3 weeks or so, where it could actually top out at least on a monthly basis, possibly well into Q1, and from there fall off. So 86.15 is a meaningful zone of resistance, trend defining in a sense, because if we close above it, we actually should then retest this high area, and I'm just calling it the 86.80s that goes way back to the early part of this year. But until then, holding below 86.15 actually maintains a bit of a bear market right now. And once again, I think over the weeks ahead, we can actually test that 85.32 formation. Once again, the start of a wide zone of long-term support down to 84.86 that can absorb selling through next year. Let's move on to the IEF, or the 7 to 10 year Treasury bond ETF. Once again, a weekly chart. I'm showing you this chart goes back, some 14, 15 years, and I'm going to zoom in a bit and take a look at just a very simple channel top that we actually tested already this week. While I was doing this video, we were testing, and we've fallen off a bit. It's at 115.90. Very simple structure that if we settle above at the end of this week, should spark follow-through buying, possibly by the end of December, could spill into January before reaching that 118.99 channel top, where we could top out through Q1 and from there fall back. I don't see a longer-term sign of strength in this ETF, the 7 to 10 year. In other words, continued easing either of inflation or interest rates over the 7 to 10 year maturity time horizons, unless we actually close above 118.99. And in fact, holding below 115.90 maintains sort of a consolidative approach over the last couple of months. And if we close below a new channel bottom, which is only about a month and a half old at 113.55, then the ETF tips south. And the next target, I think realistically, and this is where we have higher inflation, which is obviously coupled with higher interest rates. They sort of obviously work in lockstep. So as inflation climbs on a progressive, continuous basis, interest rates will also go up. And so closing below 113.55 at the end of any week, and I give you the rate of change, as long as the high that we put out this week remains in play, we've got this as a valid support formation, 113.55 rising 0.06 a week. Now, if we push higher and we, for instance, settle above that 115.90 formation, and you need to be apprised of meaningful support downside pivot points that are longer term, just nudge me and I can reconstruct something along the lines of the 113.55 formation. But that 113.55 is not altogether different than the lows that have been placed over the last 9 months or so. And so I could show you what those lows are and give you numbers for those lows, but I think plain and simple, just closing below this structure does pivot this market south. And I think we should then, over the next, the timing of this is obviously impossible, 3 to 5 months, could push into the middle part of next year, Q2, where we reach that 109.61 descending channel bottom. And we also have an ultra long-term channel bottom at 105.19. That was actually tested in 2018. And we rallied nicely to the channel top. So we are inside of the bounds of this long-term channel structure that stretches back some 15 years. I guess the point I'm making here, and I'll get back to it, is closing below the 113.55 formation should actually send us south to 109.61. I'm going to say it's a likely 3 to 5 month target, and it's dropping gradually, actually converges with that long-term channel bottom at 105.19 presently, all comes together in August of next year. So in about 8-9 months or so, it will all converge. So we'll keep an eye on that. But once again, closing below 113.55, this ETF, the IEF, is bearish then into Q1, Q2 of next year, or until we happen to test the long-term support area. Finally, we've got the iShares Core U.S. Treasury Bond ETF, symbol GOVT. This is a mix of maturities, but it stretches out into the 30-year, 20-year, even 10-year. I think the average maturity is less than 10, but it is, for the most part, representative of the long-term Treasury bond market. You can see here we have ourselves a head and shoulders process that's typically a bearish setup, although we don't have the signal until we actually close below the neckline that is presently at 26.19. I'm going to zoom in a little bit and show you that you have the 26.19 trend line that's changing very gradually. I mean, I don't think it becomes 26.20 until later December. But right now we do have a near-term channel top that we actually tested this week at 26.69, and it is dropping at 0.01 a week. And so it is our sort of near-term ceiling, below which we can quite easily fall back to that 26.19 neckline or trend line off those lows. But if we close above 26.69 or that formation at the end of any week, then we have, I'm going to say 3 to 5 weeks, could spill into January before reaching 27.15. And that is like the previous contract, the IEF, and the GOVT, that is our sort of mid to longer term ceiling. In other words, we could top out at 27.15, at least on a quarterly basis, possibly into later next year, and fall off again, once again, to that 26.19 neckline. But, if we were to close above 27.15 at the end of any week, then we actually have longer term bullish continuation. And I'm not even prepared. I'm just going to say we'll probably get back up into those highs in the mid 28 area. I don't even have it labeled. So if we get the rally, if we get the settlement above 26.69 and we begin approaching this 27.15 channel top, I'm watching a lot of markets. Feel free to nudge me by email or on the YouTube channel and request an update on this, and I'd be happy to apprise you of what would be the actual objectives if we closed above that 27.15 formation. And that would obviously be a lower inflation, lower interest rate environment as we move into the later year. Right now, this market is being challenged by inflation, of course. We are in the low area over the last year or so. The neckline is significant. If we close below the neckline with regard to the head and shoulders formation, you basically, just turn that sucker on its head. No pun intended with the head and shoulders formation. But, if you do the math, if you take a look at the head against the neckline and just sort of reduplicate that distance to the downside, you essentially get a retest of that low area over the last 6-8 years or so, between 23.82 and 24.06. That becomes a realistic objective if we close below that neckline. Now, I don't know how long it'll take to get down there. We might get down there within a year, might take a couple of years. On the way down, presently, we would have a channel bottom that I'm actually not ready to even give you the exact price of. It's in the 25 handle, but because it's based entirely on this week's high. So all we have to do is push a little higher next week, so forth and so on, even get that short-term buy signal I mentioned earlier above 26.69, and that channel bottom has to get reconstructed. But closing below the 26.19 neckline, we are in a longer-term inflationary, climbing interest rate environment. I think that's the takeaway here with the big picture. Holding above the 26.19 neckline, it's pretty much not so fast. And as I say, closing above 26.69, I think that's probably, let's just call it like it is, a kind of a continued COVID environment where the economy is dampened, throttled back, and then you've got obviously a lower inflationary market there, lower crude prices, et cetera, et cetera, et cetera, and the market can quite easily and should then rally to that 27.15 channel top. That becomes signal technically with a settlement above 26.69. I think that pretty much covers it. Please click like. Please click subscribe. That helps me out a great deal with the YouTube presence. I appreciate your support. And that's all I have to say for this particular video analysis on the SHY, IEF, and GOVT.